Earlier, Bob Michael at JP Morgan turned around to us at the top of the show and just said, this is the one, the end of the bull market. Your thoughts, Mike?
Well, first of all, I think it's premature to be calling the end of a bull market. I do think we're going to, and I was listening with great interest to the last guest as well. I do think there's a couple of things we need to sort out here, Jonathan. First of all, we are going to need to see some progress in terms of containing the virus. Until we see that, I think markets are going to continue to be volatile. Secondly, we need to be able to quantify what the economic fallout is. I think what we're seeing right now is asset markets are beginning to price in the uncertainty of not knowing where the bottom is and also not knowing what kind of economic fallout we're going to see, because it's really hard to model out the human aspect of this, and obviously so much of that depends on it. I think the third thing we need to see, which was also alluded to just a moment ago, is we do need to see better cooperation and collaboration among policymakers. Now, historically, what that's meant throughout this financial crisis, the post-crisis rather, has largely been about monetary policy. But I think we need to see more than that now. We need to see a coordinated fiscal policy response as well.
Mike Ryan, Jeffrey Yu has said there is a wall of money out there, and it is the underpinning of enthusiasm here. Is that wall of money still there?
Look, Tom, I think there's still a lot of cash on the sidelines. I mean, if we look at the way our clients have reacted to this, throughout this entire bull market, we've had lower than average participation and higher than normal cash balances. There's been a certain defensiveness to this entire bull market. That those cash balances still remain fairly high. I suspect that once we get to see some of those signs of stabilization I just talked about, you start to see this money put to work. But I don't think it's going to happen in days like today. I just think today is too difficult for people to step up and put money to work when you have this kind of volatility swing in the markets.
Mike, people talk about the economic shock that stems from the coronavirus and the possible containment measures that we're seeing from the likes of Italy. There's also the concept of a financial shock. And I'm wondering, given the market moves that we saw today, given the speculation of unwinds, how much are we going to see a financial shock that will exacerbate any economic downturn?
I think there's three elements here. One is there's the destruction of demand. There's certainly a certain level of destruction of demand because there's certain services that you simply can't recapture. There's lost wages and there's lost consumption that can't simply be recaptured. There's part of demand that's deferred, and that is stuff that we know there'll be a catch-up and we know that there'll be a rebound in manufacturing. And then there's another element is what happens in terms of the exacerbating that through a tightening of financial conditions. And I think this is why we need to see a more concerted policy response, because I agree with the last guest. In the absence of a fiscal and a continued monetary policy response, this tightening of financial conditions could lead to exacerbating the economic fallout.